Welcome back to another episode of Multi Family AP360, and our guest is Keshav Kolur from Clive Capital. So, welcome, Keshav.
Yeah, thanks for having me on, Rama. It's an honor to be here.
Awesome. And little bit about Keshav. Keshav is principal and founder of Clive Capital, a private equity firm helping investors move behind the stock market into alternative assets such as real estate and energy. And they have successfully renovated over 1,000 plus apartments and built 900 plus single family homes across three US markets. So, with that, Keshav, you want to add anything to your background?
Let's see. Yeah, I guess real quick, the numbers might be a little out of date, but our investors, we've helped them invest into, it's now over 1,000 apartments under renovation, and it's over 500 single family homes under development. We're expanding into other asset classes as well, like industrial real estate, mezzanine debt, or private lending in general, and oil and gas, primarily for the tax benefits. So our goal is really to help our investors passively invest into a diversified portfolio of these private equity opportunities so that they can get superior returns. We typically target 15 to 30%. They can get passive income and tax benefits with risk mitigation and things like that. And eventually, our goal for our investors is that they have 10, 20, 30 investments, paying them $20,000 a month, whatever that number is for them. And that allows them to achieve financial freedom and go after their other goals in life.
Awesome. Thank you. So, what is the reason behind picking like alternative asset classes like apartments, single families, or energy sector or industrial plan like that?
Yeah, yeah. This started when I was first out of college 5 years ago. I was looking at what I could start investing into, and I knew that historically the stock market did only 10% per year. And I just knew that there was no way that everyone sat and accepted 10% returns a year. Other people out there were definitely doing better than 10% a year without getting into anything really high risk. I knew the wealthy were investing differently, but I didn't know how. So that inspired me to read Rich Dad Poor Dad, which I'm sure a lot of us know, and Robert Kiyosaki talks a lot about real estate. And so that got me thinking about real estate. And in real estate specifically, we focus on apartment buildings and industrial real estate. With real estate to start, we'll talk about the other asset classes in a bit, but our returns that we project are higher for our investors. If it's acquiring an existing building, it's between a 15 to 20% return. If it's a development, new real estate construction, it's typically 20 to 25% return. That's beating the stock market there already. Now, people might say that, hey, there's risk in real estate and things like that, but if you invest with the right group, majority of the time, 8 out of 10, 9 out of 10 times, your deal will succeed and you'll make that really high return, 20 to 25% or 15 to 20%. And there's studies out there. We have some educational material on our website, clivecap.com/alternative-assets that show that portfolios with a traditional 60-40 split of stocks and bonds, when you add just 10% commercial real estate in there, and when I say commercial real estate, including multifamily buildings, just any real estate bought for income purposes, that increases the returns of the portfolio while decreasing the risk as well. And so it's typically a safer place to invest than the stock market with superior returns also. So those are two things. Third, that's real estate, right? A third, I would say you also get passive income. For example, apartment buildings that we buy, people and families are in there paying rent every single month. And we have revenue left over from that that we then distribute to our investors. So they get monthly payments. We bought 100 apartments in Virginia with our partners in June. And we just distributed our first returns to our investors from those returns, and they were getting thousands of dollars every month, and that's life-changing for people. So passive income is the second thing. Third is, I'll say, tax benefits. In the stock market, you have capital gains. That's really about it. And maybe there's some stuff with dividends, but it's nothing crazy. In real estate, for example, your income, your cash flow can go tax deferred thanks to depreciation. And what that means is if you're making 8% return per year, for example, on an apartment building that you invested in, you don't have to pay taxes on that. I'm not a CPA, I should say, but you don't have to pay taxes on that for the first few years until you go to sell. That's one. Energy is even more powerful for tax benefits because the depreciation you get in energy, oil and gas, for example, can be used to directly reduce your taxable income, regardless of whether or not you're in the real estate or regardless of whether or not you're in the oil industry. What I mean by that is in real estate, those depreciation losses I mentioned can only go towards reducing your real estate passive income. They cannot go towards reducing your W-2 income, for example. And unless you or your spouse is a real estate professional. On the other hand, in oil and gas, you don't have to be an oil and gas professional to take the deductions against your W-2 income. For example, I invested into an oil and gas opportunity in November of last year, 2023. Every 100K invested, I got a depreciation paper loss, just a loss on paper, not me actually losing money, of 80K. So every 100K, I got to reduce my taxable income by 80K, even though I wasn't an active partner. I just invested passively. That kind of benefit you're not going to see in the stock market. And on top of that tax benefit, 80K, a reduction in 80K of taxable income typically equates to about 20 to 30K in tax savings, depending on your tax situation. But on top of those savings, I've already made a 40% return in the last year as well on that oil and gas. It's been sending me monthly checks because of the oil and gas that's been drilled every month and sold to the markets. So tax benefits is third. I guess we said risk mitigation would be four. And I would say like diversity. In the stock market in general, if one stock goes down or if a war breaks out somewhere, the entire market's going down. Even if your market's not, even if like Meta stock is completely unrelated to a war breaking out. On the other hand, real estate, for example, your apartment building's value is not going to change just because a war broke out somewhere. And that's just because investors panic and buy and sell sometimes like monkeys, honestly. But in private equity investments, we are a lot more disciplined, I would say. We don't just buy and sell at the drop of a hat. We lock up our capital, and it's inconvenient that we lock it up for some reasons. For some folks, I agree. But when we lock it up, on the other hand, that gives us higher returns, some of these tax benefits we would not get otherwise.
Awesome. Thank you for sharing that. So when you're working on different asset classes, so how exactly you will pick markets? How exactly pick sponsors? Share your criteria.
Yeah, the kind of six criteria that we look at investments with, and this is just what I've gained from my own experience and then talking to investors as well. Investors are looking for a combination of usually six factors: appreciation, how much is my asset going to increase in value? Cash flow or passive income, how much is it going to pay me every month? Tax benefits, right? How is it going to help with my tax situation? Risk, liquidity, meaning how long is my money locked up for? And the sixth one that I found recently is altruism. People who invest into investments that are do some good for the world, that are charitable while still getting you decent returns. So we try to pick investments on all different scales of the spectrum so that our investors have different needs for their portfolios. Some might want really high tax benefits. Others might want really high appreciation. Some might be really good people and very charitable people. They want altruistic investments. So we look at building a portfolio of investments that accomplishes all of them. We are not saying everyone has to participate in all of them. And luckily, we have a customizable fund where investors can go and they can see all of our opportunities in one portal. They can pick and choose which investments they want. So some investment, again, might be really good for tax benefits. They can invest into that. Another investor who might be really interested in cash flow, just cash flow. They might be interested in our private debt investments. And so we try to bring a variety of investments that achieve different levels of these 6 characteristics I mentioned. And obviously, we spread out geographic risk as well. So we invest all over the country. Primarily, right now, at least as far as real estate's concerned, on multifamily, primarily into landlord-friendly states. But in some asset classes like industrial real estate, for example, it doesn't matter as much whether it's landlord or tenant friendly. So we primarily don't have geographic markets that we focus on. On that being said, I think there's a huge focus on that in the industry in general. I primarily focus on who am I working with and how experienced are they. Because money can be made anywhere. Money can be made in the middle of Nebraska. It could be made in downtown New York City. It could be made anywhere as long as you have the experience, you have the right network, the right connections, etc.
So how do you find these strong operators?
Yeah, that's a great question. For you and me, that's our jobs, right? It's our jobs in the industry to go out there and to network and to find different operators. And that's what I pride myself on, is finding different operators beyond just multifamily apartments, because that's great, but I like to give myself and my investors an edge. When everyone else is investing into apartment buildings, I like to find something else that is a good investment that people aren't investing into and get into that early. A lot of it comes through networking, some of the network groups that you and I are a part of, and paid network groups. But if you're not wanting to join paid networking groups, then you can also go to your local real estate meetups and find people there. That's a great source. Word of mouth, ask anyone who's investing, who they're investing with. And social media is a great one too. Since 2012, the Jobs Act came out, I believe, and that allowed us to advertise our investment opportunities. Now you can go and search for people in the investments that you want to make. If you're interested in investing in solar investments, you can go and search for solar investments. That being said, there's always risk just investing with people you find online, and it's very important to do your due diligence. There, again, that website I mentioned earlier, clivecap.com/alternative-assets. Another thing we included is 100, I'm pretty sure it's 100 questions, 100-question due diligence checklist that you should be asking anyone when you're investing with them. Some of the questions include, what did you do before you started this business? Tell me about your worst deal. What happened? What did you learn from it? How did you handle it? Tell me about your investment thesis, right? And tell me about your friends or family who's investing. Tell me how much you have invested. Things like that will get you a pretty good gauge. And then obviously ask for testimonials as well. In this industry, we have to work with a lot of other professionals, including lawyers, accountants, insurance companies, contractors, banks, I said lenders, and other investors. So I talked to all these people and asked them what their experience was working with this person. So those are just some of the questions that I usually like to look for when I'm evaluating someone new, whether I should be investing with them, whether I should be investing my investors' capital with them.
Yeah, great questions. You mentioned like you're focusing customizable fund size. What are some advantages or benefits with going with customizable funds?
Yeah, it's a great question. Primarily, it's you have one person now to rely on to help you diversify your portfolio. As a passive investor, my background is in tech. A lot of my investors are from Amazon, Meta, Google. They're really busy. They don't have the time to go out there and talk to 10 people in the apartment building space to figure out who they should invest with. Apartment buildings are easy. They don't have even more time to go out and figure out who they should invest with in oil and gas, because the oil and gas industry is even less well understood than real estate. So one benefit of a customizable fund of funds is that you can rely on the fund managers to have a broad network across all of these different investments, opportunities, all of these different asset classes, so that you don't have to go out there and form the relationship yourself. That's one. I would say two, you have one, for me at least, you have one portal, investment portal, where you can just log in and see all of our investment opportunities in one place. You don't have to worry about, hey, my apartment building investment portal is this one, my oil and gas portal is here, and my private debt one is here. You have one centralized place, and that's easy for you, or if you want your spouse to help you track it. And two, when we distribute tax returns, we distribute one tax return for that all the investments through that portal, rather than multiple tax returns per investment. And let me see. Lastly, I would say, yeah, I think it just allows you to diversify your portfolio a lot easier because all of the opportunities are in one place through one source, your fund manager, who you should vet, make sure they're the right person to work with.
Awesome. Yeah. Thank you.
And I would say you could pick and choose, lastly, you can pick and choose which investments you want, which is the point of customizability. If there are 10 investments, and my goal is usually to bring 5 to 10 investments for my investors every year, you can pass on investments 1 through 5 because you don't like them, and only invest in investments 6 through 10 because those are the ones that you do.
Yeah. So diversification, right?
Yeah.
So like from macroeconomics point of view, like inflation and supply demand, all these factors influence overall investment strategy, right? So how exactly you consider these factors when you're picking different asset classes or different markets?
Yeah. I could word vomit right now, but I'll try to keep my thoughts more organized.
Yeah.
Each of the asset classes we're in, I'm trying to think here. I don't want to say they're all doing pretty well because oil and gas, for example, is very volatile. But apartment buildings, for example, depending on where you're investing right now, because we know real estate's a local market, you have to pay attention to the locale. Some deals are doing really well because they're in smaller markets that were not flooded with new construction during the low interest rate years of COVID. And they were bought well. Other deals that we bought or partnered with on, and some of the major metros are facing some trouble because there's just so much new supply, so many new apartment buildings coming online, new houses, that it's increased vacancy a little, and it's decreased rents because there's just so much new supply. That being said, interest rates have been high for a year and a half, 2 years now, and high as in for the last 10 years. Historically, it's nothing compared to the 80s when it was
Yeah.
like 15%. But in the last decade, people think it's high. So we'll call it high for recent years. That has taken out a lot of the supply or like the competition from the market, really. A lot of people got out of the game because they said, hey, interest rates are too high. I'm not going to go out there and build a new apartment building when my cost of capital is 12%. That's what the interest is that I'm paying. But so we see that supply is going to come down here in the next few years because new construction starts dropped. But on the other hand, demand hasn't slowed down. Demand continues to increase, and that's because home affordability hasn't improved much. Home prices are still really high, even though interest rates are really high. And what that means is it's more expensive to buy a home. Your monthly payment is very high, and that means if you can't make that payment, then you have to continue renting. So demand for rentals increase. But if that demand is not being met by the supply that we mentioned is shrinking because high interest rates have dissuaded a lot of developers from coming out into the market and developing, then multifamily is looking good. New construction is also looking good. If you are able to build, then you can take advantage of less competition and introduce new supply to the market. Our private debt opportunities have been doing pretty well also because interest rates are relatively high in recent years. And industrial real estate, which we're getting into, we expect to do pretty well with Trump coming into the office, his proposed tariff plans that's going to bring even more manufacturing back to the US. That's going to increase demand for manufacturing space and industrial real estate. So we expect that to do really well. And oil and gas is a bit interesting. We have seen a lot of supply come on recently. Saudi Arabia has abandoned, last I read, at least abandoned their dream of $100 a barrel, and they're going to keep drilling. And then I think demand has come down as well, just with higher living costs in general. So I think oil and gas isn't doing as well historically. We're still doing great returns though, compared to the stock market and the fact that you get tax benefits. It's still a no-brainer. For me personally, I work at Meta. We just had our stocks vested a few days ago. I sold, and I'm planning to put all that into our next oil and gas opportunity.
Yeah, thank you. The detailed explanation. Thank you very much. So, would you share any of your best experiences so far?
Like best investments?
Yeah.
Yeah, I would say the oil and gas investment that I made, I'm plugging my computer in here, is definitely my best investment that I've made so far. I passively invested into an oil and gas opportunity where we bought land in Wyoming, and a private billion-dollar company came in to drill on that land. Now, because we're owners of the land, we are entitled to a share of the revenue from the oil and gas that is drilled and then sold. So like I mentioned, every 100, and that was in November of 2023. So every 100K invested, I got to write off 80K, reduce my taxable income by 80K, including my W-2 income because I'm still at Meta. And even though I was a passive investor. And then second, I've made every month between 2 to 3% return on that investment so far for the last year. I think I just did the math, and it was about a 40% return in the last 12 months. That being said, oil and gas, the returns do decrease over time because you have less oil and gas to drill and sell. But you get between a combination of returns and the tax savings, you get your capital back between 18 to 24 months. And at that point, the returns that you're getting, you could almost say it's infinite cash flow because you have no capital left invested in the deal. And those are some of our best investments, targeting like a 25 to 30% IRR when you factor in the tax savings.
Awesome. So, would you also share any
Yeah.
challenging experience?
I say that again.
Any challenging investing experience?
Oh yeah, definitely. One of the very first investments that I made, it was an apartment building bought on floating rate debt. I luckily was only a passive investor in this one. And this was because it was my first investment. I didn't want to bring any investors on because I didn't even know how it was going to go. So I put my money first, and that's always something that I stand by. And so we bought the apartment building, and it was an adjustable rate loan, meaning back then that was good when the rates were really low. Now, because rates are really high, and it's a high leverage deal too, I think 80% leverage, the interest payments that we're making every month was really high, is really high. So I haven't received distributions for that deal for the last year and a half or 2 years, maybe. And all that's to say is there are deals where things get a little shaky. And we've seen people who have been foreclosed on. Luckily, this investment hasn't been foreclosed on. The partners that I invested with, they are putting capital out of their own pocket to keep the deal going and keep it afloat to avoid foreclosure. All that to say that investing, there's going to be tough times always. No one's going to ever hit 100% on their investments all the time. And that's why there's risk involved. As long as you invest with people who are trustworthy, who do the right thing, who put investors before themselves, and they're hardworking, all the good stuff that you'd want in any human being that you're associated with, honestly, friends, spouses, colleagues, people you invest with, etc., it will turn out fine. And you might have some investments that go bad where you lose capital, but that, as long as you're investing with the right people, it should be maybe 1 out of every 10 times or something. And don't let that discourage you from investing again. Get your learnings, figure out what mistake you made or what you can do differently, pick yourself back up, go back out there and invest again. So don't let one loss discourage you or defeat you.
Yeah, good stuff and good advice on that. Yeah, thank you. So, what's your company's focus next 18 to 12 months?
Yeah, our focus here over the next few years is primarily it's the name of the game is we have to find more investment opportunities to invest into, and we have to find more investors and educate them about how these investment opportunities work. So for us, we're pretty comfortable with real estate now. I'm fairly comfortable with oil and gas also, but there are other investments out there into like solar energy, for example, where I don't know as much. And so my goal is always to those 6 characteristics that we mentioned: appreciation, cash flow, tax benefits, risk, liquidity, and altruism. it's to continue to increase those. So I'm always out there trying to find new opportunities that beat the current returns that even we're achieving for higher appreciation. I'm trying to find opportunities that generate high returns with lower lockup periods. So we're in a debt investment opportunity right now where investors are hitting approximately 16 to 18% return for only a 1 year lockup on capital.
Yeah.
Yeah, so it's really find more investors, educate them about all these benefits of investing outside the stock market, and then find investment opportunities that are very niche, but very safe and help them achieve their financial goals.
Awesome. So, any personal habits that are helping you to be successful?
One big thing for me is journaling the night before, just planning my day out the night before. And that's one big thing. And another thing, probably that I should start doing, I don't do it yet consistently, is just affirmations, I would say. There's the book Think and Grow Rich, and a lot of it really is just between your 2 ears right here, the 6 inches between them. That's where the most important things matter. If you lose that battle, then you're going to lose every other battle. So just being grateful for everything that you have, even though things seem tough at times, and then mustering up strength, right? Just saying, hey, I faced this setback, but I'm not going to let it push me down or anything. So I think just those two things, gratitude and fortitude, maybe the right word. Just practicing those, speaking them out loud rather than just thinking them, I think is something that I want to get in the habit of.
Sure. So, any books impacted you personally?
Yeah, I would say Rich Dad Poor Dad is what got me into all of this. When I graduated in 2019, I went to Southeast Asia to travel with my friends, and it was a 15-hour flight. So I thought, what better way to kill 15 hours than read Rich Dad Poor Dad? Not saying that it took me all 15 hours because someone made fun of me for that, but no, that was a very impactful book. And then, yeah, I would say that's the most impactful book. There are other books in sales and things like that, but as an investor, and someone who's interested in building generational wealth, that one was probably the most important. It was the gateway drug to all of it now.
Yeah, sure. So, how can listeners can connect with you, Keshav?
Yeah, I would say visit our website, that same link, clivecap.com/alternative dash assets. There you'll see a 2-pager, like a 5-minute read probably, and then an ebook, more like a 15-minute read about why you should be investing outside the stock market. I personally, the only thing that I have in the stock market is my retirement account. That's because I have to. And whenever I'm financially free, even that will be out of the stock market. I have no interest in the stock market unless it's a hedge fund doing like 30, 40% return. And we include that due diligence checklist I mentioned as well. And then beyond that, LinkedIn's probably the best way. If you just connect with me, Keshav Kolur, I'm based here in New York City. Would love to talk to folks and share any knowledge or learnings that I've luckily been able to gather over the years.
Awesome. Thank you very much, Keshav. Thank you.